Welcome to the Norris Group Real Estate Podcast, a show committed to bringing you insights from thought leaders shaping the real estate industry. In each episode, we'll dive into conversations with industry experts and local insiders, all aimed at helping you thrive in an ever-changing real estate market, continuing the legacy that Bruce Norris created, sharing valuable knowledge, and empowering you on your real estate journey. Whether you're a seasoned pro or a newcomer, this is your go-to source for insider tips, market trends, and success strategies.
Welcome to the Norris Group Real Estate Podcast. I'm Joey Romero, and today we have a great conversation lined up for you with a true veteran in the commercial real estate lending space. Joining us today is Gil Figueroa, president of First Commercial Capital. Gil brings over 30 years of experience as a licensed real estate broker with exceptional expertise in originating, underwriting, and closing multifamily and commercial real estate loans. He has a deep understanding of complex loan programs as well as escrow, title, and documentation processes, and is known for his ability to identify strategic financing opportunities that create real value for his clients. In addition to his lending background, Gil is an experienced financial analyst and wealth strategist working with high net worth individuals to develop practical investment strategies aligned with long-term financial and retirement goals. He is also a seasoned speaker, having spent nearly a decade presenting at wealth conferences and seminars. Today's interview is especially exciting as Gil will be joined by our very special guest host and former CEO of the Norris Group. Yeah, it's that guy, Bruce Norris. So let's get started.
Hi, welcome to our show. My name is Bruce Norris, and today we have a special guest, Gil Figueroa. I met Gil many years ago. We started doing presentations with Chris German, the apartment dealer, and he is one of the very few speakers I take notes when he talks. So I really respect how he looks at charts and draws conclusions. So Gil, happy to have you back.
Bruce, I'm humbled to be invited in your presence. Before you say anything, I met you before you met me because I was in your audience. I believe it was it 2008?
Okay.
You did the fallout is coming
or it's already here.
Yeah, it was I think it was 2007 or 8.
Yeah.
And, I mean, it was fantastic. It was everything I thought that was coming. You put it all together in charts, so I'm honored to be here. You're my mentor.
Fellow chart guys. Well, you know, it's interesting because when I did the original study, it happened because of a purchase I made. So I'm buying real estate, and there's a VA property. This is trying to think about 1995, a VA property up for sale. So anybody that lives in the house as a VA has the chance to bid on it first. I'd say it's probably worth 40 grand. The opening bid's 15. No bidders. For the whole country, no bidders. Then it goes to the investor. And I'm the only bidder in the country. And there was a formula that I knew I could get it for 13.3, and I'm the only bidder. And to be honest with you, Gil, that made no sense to me. It would rent for $500, and no one wanted it on either side of the world of real estate investors or occupants. And it scared me. I said, okay, I have no idea what happened, because I'm, an investor that took the 85 to 89 run, that everything you did was right. And then everything you did kind of turned to not right. And now I'm buying a house for 13.3 and no one thinks that's a good idea. Wow. So that's why I started looking at this stuff. That was the motivation. And I didn't even want to figure it out. I wanted to find the person that did. And so I did all the research looking for that person first, went into the library and read all the articles talking about charts and timing and all that. And I was just never impressed that anybody had nailed it. So that was the start of the journey. And what's really interesting is I did myself a big favor by not thinking I already knew something was true. So when you look at interest rates, I've debated so many people that are like PhDs, and one of the first things they most always say is, of course, when interest rates go down, prices come back. And I'm just thinking, all you have to do is look at an interest rate chart to know that isn't true, which is very odd. So between 74 and 80, interest rates went from 8 to 16%. So according to their theory, prices got crushed, and prices tripled during that journey. And then, you have 2008 to 2010, or whenever the interest rates went down by a ton, and your prices crashed. So the truth is, if you know the direction of interest rate and that's all you can't tell me anything about what prices do. And so that's the interesting thing when I studied this. And when I look at you do what you do at that with that one particular chart that you look at, I know that you studied that where that has more meaning to you than anybody else. Because you really have it's like in science, you go, okay. And so I want to first of all talk about the chart that you usually look at when when you're talking in front of the apartment group. What is it that you're looking at, and what tells you the direction it's likely to head?
Wow. So I look at the 10-year Treasury.
Okay.
There's either the credit, the 10-year futures chart, or TNX, which is about the same. So they both track each other. So the market develops a certain pattern. All markets do. They develop a pattern, and it's just human characteristics as patterns. Optimism, negative, fear, greed. Those are your basics, and the market moves on these patterns. Over the years, I'll tell you what really got me, really in depth with this market was back in '08 and '07 when you were particularly, right on target about the market falling apart. I was following an Elliott Wave technician. They had a newsletter, and their newsletter was predicting the same thing. And I thought that was interesting that you and them came up with the same collaboration, but yet with different sciences as far as what you're looking at.
Correct.
Me at that time, we were doing maybe 50% production was single family, and it had zero fundamentals. We had the heartbeat loan where you had zero down and
Right.
only a FICO score, and the income was made up, like you've said many times. It was
Right.
definitely made up. We were a broker. We brokered that, and I used to ask the investors, the countrywide of the worlds of, how do you price this? How does this not mitigate risk without any income documentation or showing the ability to pay? I thought it was outrageous. And they said that, well, we've never had defaults. We haven't had defaults in this market. Our market is very little default. And my conclusion to that statement was, just because you haven't had them doesn't mean they're not coming.
That's right.
Yeah. So that didn't really correlate to me. In '06, I started winding down my company from doing the zero down. I canceled our countrywide contract, which was very prosperous at the time. But Countrywide had an idea that something was going to blow up because they wanted us brokers to guarantee or pay the default within 12 months of default.
Wow.
So if a client did any 12-month default, irregardless of fraud, us brokers would have to cover that. I said, they know more than they're telling us here.
Yeah.
And this is, I can't rest our small company on this risk. I can't mitigate this risk. There's no way. And that's when I really shifted over to commercial work. I thought it had debt service. It had a real analyzer of what a borrower should look like. It was more tangible. It had real underwriters. They didn't have the more automated systems that the single family market has. So I just thought it was the logical approach. So in, I believe, '08, '09, I closed down my company, which was strictly, like I said, 50-60% residential,
Right.
and opened First Commercial in 2009, strictly on an investor model. Only work with investors, only a non-owner model, and we're going to look for investment assets and residual income, and have great clients that are long-term clients. So that was our position change at that time. My real focus started not only looking at that Elliott Wave forecast newsletter, but also learning that Paul Tudor Jones in 1987 actually made millions in a matter of days by calling the top of the market. I got to the point where I really researched him, and to the point where I understood that he was also an Elliott wave technician.
Okay.
And now he's, a billionaire hedge fund. I don't know if he's probably retired. He's in his 70s. I would assume he's retired. I would be. That really caught my interest. Then when the market did drop, as you stated, and a lot of the Elliott wave guys stated the same thing, I was fascinated. I was hooked right there. I was like, wait a minute, this is real forecasting. This is not just maybe. This is definitely.
Yeah, so, when you put something in writing, you're stuck with it for a while, and like forever, especially if you did it in advance of it happening, because it sounded so outrageous. So back then in residential real estate, you could do no wrong. Everything you invested, even in 2006, exploded in 2007. And we actually had someone on the radio show, I think it was January of 2007. And a guy I really respected was still having everybody buy houses all over the place. And I told him, you can get everybody out. You still have time. You'll walk away a hero, man. He had probably 5,000 houses he had sold to investors that they had owned like 20 a piece. And one of them heard me speak, and he came to me, and he had a page like it was stapled together. He had 30 some rentals with negative cash flow of 20 grand a month, but he had a net worth of $3 million. And I said, well, how do you pay for this? He says, I sell other people houses to the same concept. And I said, I think you got 6 months to run away with your 3 million, man. And that's it. And he didn't.
He had a net worth on paper, Bruce.
I know. Yeah. But that could convert, because he was still in that mode where you could sell it all, but boy, after it changes, so how closely do interest rates correlate with commercial property valuations, let's say? So if interest rates are going up, are apartments automatically getting hit because it's part of the formula? Is that how it works, or is there times where that's not true?
That's a good question, and I don't have the historical analysis. I didn't prep. You didn't give me any questions, Bruce.
No, perfection is too.
I didn't prep for that, but I would say, let's say in today's market, since we hit a peak of, when we went into 2021, 22, we had the highest price per unit. We had the lowest cap rates. Then rates started to move, and the price per unit dropped, no question. Our cap rates increased, no question. And as the rates become higher and higher, there has to be a certain arbitrage between the actual rate and the cap rate for the investor to make any money. So it's a simple analysis of just metrics and math. The only time that can be circumvented is if there's maybe an underground positive movement towards apartment for whatever reason there might be.
See, what was really interesting about housing, so in California, we're up to maybe a 8.5, 9 times multiple of median income. In 1972, we were at 2.2. And so when the mid 70s hit and the interest rates went crazy, we probably got up to a 5.5 multiple. But there was room for all that to happen, because before it wasn't taking any of your money to own a house. And, all of a sudden interest rates went crazy, but prices accelerated and got to that affordability number that we look at and say, okay, you're done at 17%. And then that was replicated. So what's interesting, and I go to this question, when we did one of the last reports talking about, maybe a 10-year, we either need a 1% mortgage rate, or we're going to be price dormant for 10 years because there's no place to put an extra nickel on a payment. And, we've really gone down that path where that's been true, where residential real estate hasn't gone down. But see, this is an interesting question. One of the reasons residential has gone down very much is we have this base of 2.5% mortgages to 3.5% mortgages, and those people have a payment that's rent equal and aren't going anywhere. Okay, so that's very unlikely to be a foreclosure group. But in the commercial world, you may have that rate to start with, but that doesn't mean you have it forever, right?
That's right. Ironically, the 30-year fix does exist for multifamily.
Right.
Okay. So we do have lenders that offer it, but it's always at a higher yield,
Right.
typically at least 1% higher than your 5-year yields. So people can't really, get over that hump. I remember meeting a very big investor worth over 100 million sometime in early 22, and he mentioned 30-year fix for his whole portfolio, and I told him it was the most brilliant move he can make. And I had pricing for him, and he went all the way to the table and decided, no, I'm going to take a 5-year. And I said, why? You're retiring. You're done. I'm telling you, treasuries are headed to 5. You can lock in now at a 2.5 treasury in mid 22. And he decided to take the 3 3/4 rate instead of the 5 1/4 rate on a 30-year fixed. He's called me back. He said he was wrong and I was right, but I'd rather he had done the right thing. I mean, it takes a little more of a lump in commercial world to accept the 30-year pricing.
Sure.
The Fannie Freddie model on single family is a little tighter, so there's not enough spreads on that 5-year for single family compared to the spreads available for multifamily. So there's a different spread, and that makes people a little greedy, and people take a 5-year instead of a 30-year. Now, also, as the rates are lower, the leverage will increase. Okay, so you have more leverage because of the debt service factor that multifamily loans use that single family don't use. They use a global debt ratio versus a debt, service.
So at a very low interest rate, you would get more loan to value, basically. Okay,
Yes.
because they're payment conscious rather than LTV conscious. Okay. What happens? Okay, let's say typical is a 5-year fixed, and then there's an adjustment. Is there always an adjustment possible, or does the loan just get called?
No. There's balloon loans and there's hybrid loans, just like single family.
Okay.
So you have 30-year amortization with a 5-year 5/1 arm, which is what they're called, and now we're tied to SOFR. SOFR plus 2.5 to 2 3/4 is the norm. So that rate would be somewhere around 6 today, in that range.
Okay.
6 1/4.
That's not terrible.
It's not terrible. It's not
Okay.
terrible. But it is terrible for someone who bought with a 3.5% rate and during COVID or right thereafter, and weren't allowed to raise rents because of certain restrictions, especially here in California, and now are dealing with a payment twice as much with maybe the same metrics as what they started with.
Right. Yeah. I mean, that's the thing. You've seen that journey of decisions, but also when the lender looks at what they view as the value, do you have owners having to bring in money to accomplish a refi?
That's funny you should say that. A lot of owners aren't refinancing. They just won't do it. They won't bring money in. And lenders aren't forcing them, which they can. Lenders could force them because technically they're non-performing loans if they're not debt servicing. So,
right.
But the extend and pretend everything is all right is kind of the way it's been.
I was kind of wondering if that was the lender's choice or if there was something above them that said, no, you can't do that.
Well, if it was one lender in trouble with non producing loans or let's say in default, then it would be that lender's fault. But this is across the board, Bruce. It's too big. It's a problem too big to basically call all lenders in default. Then the banking system would be crushed.
Right.
So the economy would be, in big trouble. There's a lot of money on non-performing debt service, I should say, loans. They're still performing. They're paying their payments.
Right.
But technically, they're not servicing at that 120 or 115 coverage that they started with. So that's
Right.
a contractual element of default.
Okay. Just watching YouTube videos, there's a few big investors of apartments that are starting to buy some wholesale deals where lenders have taken them back. I don't know if that's happening in California, but I think he's in Arizona. We're talking about Phoenix, where he's, buying stuff at 40, 50% off of where the loan was.
Wow. Yeah, I haven't seen it in California yet. I've seen some decent deals, but nothing at that level. I've seen some in Texas that have dropped that far, but I have not seen anything in California as of yet. But my footprint is, generally California for multifamily. We do lend nationwide.
Okay.
But the majority of our clientele is based in California.
Well, that's going to do it for this week's episode with Gil Figueroa, president of First Commercial Capital. Please join us next week for part 2. See you then.
For more information on hard money loans, trust deed investing, and upcoming events with the Norris Group, check out thenorrisgroup.com. For more information on passive investing through the DBL Capital Real Estate Investment Fund, please visit dblcapital.com.
The Norris Group originates and services loans in California and Florida under the California DRE license 01219911, Florida Mortgage Lender license 1577, and NMLS license 1623669. For more information on hard money lending, go to thenorrisgroup.com.